Welcome to the Deep Dive. Today, we are really digging into the Q3 2025 earnings circuit and focusing in on Dexcom, that's DXCM.
Yeah, and the story here is, well, it's a classic Wall Street puzzle, isn't it? You've got this quarter of just incredible execution.
Record numbers, really.
Absolutely. Followed immediately by this really painful market sell-off, a huge drop.
So that's what we're doing today, a deep exploration of that Q3 earnings call. How did those strong results get so completely overshadowed by a, let's say, cautious outlook?
Exactly. The stock dropped, what, double digits in just one session? So our mission here is to distill, the key financials, the strategic stuff, the catalysts.
And especially that controversial 2026 commentary for management.
Right, to give you absolute clarity on where Dexcom might be headed right now.
Okay, let's start with the good stuff. That amazing execution, the hard numbers. They were exceptional.
They really were.
Dexcom reported worldwide revenue of $1,209 million. That wasn't just a little beat.
No, it blew past the consensus estimates. Those were around $1.18 billion.
Yeah, roughly. And it showed really solid year-over-year organic growth, too, about 20%.
And that growth pattern, especially internationally, that's pretty impressive. Organic revenue growth outside the U.S. actually accelerated for the third straight quarter. Hit 18%.
Wow.
But the real headline, I think, was profitability. Non-GAAP EPS came in at $0.61.
Comfortably beating the $1.57 consensus.
Right. And that number, there were 61 cents, that's actually the highest quarterly earnings per share Dexcom has ever reported in their history.
So, okay, let's just recap. Record revenue, record EPS, and the balance sheet looks great too. Right, liquidity is fantastic. They closed the quarter with over $3.3 billion in cash and equivalents.
Solid footing.
So why? Why did investors just slam on the brakes? Why focus on, the distant future of 2026 instead of this genuinely historic quarter?
That's the million-dollar question, isn't it? And what's really fascinating is just how fast that negative sentiment took hold.
Yeah, it wasn't gradual.
Not at all. The market didn't just raise an eyebrow. It reacted with extreme caution, huge volume sell-off, and it seemed purely driven by those forward-looking comments.
The dreaded guidance commentary.
Exactly. The short answer is probably this raise and reset narrative that took hold. They did raise the revenue guidance for the full year.
Right, let's get into that. The full year picture. They did raise the top line guidance. Management now projects FY25 revenue between $4.630 billion and $4.65 billion.
Which signals about 15% year-over-year growth. So that's the raise part.
Okay.
Now for the reset, and this is where the market, I think, really got hung up. Management lowered the non-GAAP gross margin guidance for FY25.
Significantly lowered it.
Yeah, down to approximately 61%. That's quite a step down from where estimates were before. And this margin pressure, it's absolutely crucial to understanding why the stock reacted the way it did.
Wait a minute, that margin drop is pretty steep. Is this just a convenient excuse blaming past issues, or is there a real risk these costs stick around longer than they're saying?
Well, that's the key question analysts were wrestling with. Management was pretty clear that they see the margin headwind as basically a high-quality temporary cost.
Temporary.
Driven by two main things, contributing roughly equally, they said. First, higher than expected. Swap rates at the manufacturing facilities.
Scrap rates. Explain that quickly.
Sure. It's basically the amount of product inventory they have to discard because it doesn't meet their quality standards during production.
Okay, so why were scrap rates suddenly higher?
It was tied directly, they explained, to the extra scrutiny they put on third-party components.
Yeah.
Remember those out-of-box failure issues they had with the G7 sensor rollout earlier in the year?
Ah, right. The initial teething problem?
Exactly.
Yeah.
So essentially, they tapped the brakes on volume production to double down on quality control for those components. That inherently drives up per-unit production costs, at least temporarily.
So they were effectively paying a premium in the form of discarded inventory just to be absolutely sure those G7 quality issues are fixed before scaling up more into 2026.
That's a good way to put it. A proactive quality investment, you could call it.
Okay, what was the second factor?
Second factor was ongoing costs from expedited shipping. These are tapering now, they said, but they were still a factor in Q3.
Because they needed to stabilize the supply chain quickly after the G7 launch issues, right?
Right, precisely. They had to rely heavily on expensive air freight instead of the much slower but much cheaper methods like ocean freight.
But management sounded pretty confident these are, transient issues. They specifically noted the cost structure should get back to normal as they move into 2026.
Yeah, especially as they shift back to ocean freight. They actually mentioned they started using ocean freight again late in Q3.
Okay, so the expectation is that pressure eases.
That's the narrative. And their actions kind of back up that internal confidence, wouldn't you say? They announced plans to settle $1.2 billion, that's a billion with a B, in upcoming convertible notes entirely in cash.
Wow. Okay, that's a huge signal about their balance sheet strength and their belief in future cash flow.
Definitely. And what's more, given where the stock price ended up after the call, the company confirmed they plan to continue with more share repurchases this quarter, buying back their own stock.
Right. Which speaks volumes about how they view the current valuation versus their internal outlook.
Indeed.
So speaking of internal confidence, how are they translating that capital strength into actual growth? The call highlighted expanding their market, right? Specifically that type 2 non-insulin group, the NIT population.
Yes, that expansion into the non-insulin market, that's clearly the big long-term growth engine they're focused on. And we are starting to see real progress on access there.
Let's quickly define terms, NIT.
Right, NIT refers to the estimated 15 to 20 million people with type 2 diabetes who manage their condition without using insulin. Big market. Access for devices like CGMs is typically managed through PBMs.
Pharmacy benefit managers, the gatekeepers for coverage.
Exactly. And Dexcom confirmed they now have coverage established for nearly 6 million of those NIT lives. That's across the largest U.S. commercial PBMs.
So roughly half the commercial non-insulin population now has access.
That's about right. And getting that access is critical, especially with Abbott's Libre franchise also heavily targeting this massive patient group.
Competition heating up there.
For sure.
And they're not just relying on access, they're innovating too, right? To kind of pull those newly covered patients in and improve the clinical utility. What stood out in the product pipeline discussion?
Yeah, I think there were three key things, three catalysts really, aimed directly at strengthening their position in this next phase of the CGM market.
Okay.
First, the digital side.
Okay.
They introduced AI-powered meal logging. That's going into both the Stelo and the G7 apps.
AI meal logging. Sounds fancy, but is it useful?
Well, they argue it addresses a core need, particularly for type 2 patients trying to manage diet and lifestyle. It gives more direct feedback on how food impacts glucose beyond just the raw numbers, more behavioral.
Interesting. Okay, what's number 2?
Second, and this could be huge, is the clinical simplification angle. They submitted the Dexcom Smart Basal titration module to the FDA.
Smart Basal, what does that do?
Basal insulin titration, figuring out the right background insulin dose, it can be pretty daunting, especially for type 2 patients worried about hypoglycemia going too low.
Yeah, that's a big fear.
Right. So Smart Basal is designed to simplify and speed up that process. If approved, it could really unlock wider adoption for type 2s who need that basal insulin management but are hesitant. Makes it easier for doctors and patients.
Okay, that sounds potentially significant if it gets the green light. And the third item?
The third one is the G7 15-day wear system. This has been talked about for a while, but it's now moving towards a broader launch.
Because they secured coverage.
Exactly. They got robust coverage from Medicare and all the major commercial payers, crucially, at the same net price as the current 10-day G7.
Same price but longer wear. That 15-day system, that sounds like it could be a really important margin driver over the next few years.
Absolutely. Less waste, fewer sensors needed per patient per year. It drives down their manufacturing costs per year of therapy for each patient. So it's critical for competition, retention, and definitely for margins.
Makes sense.
And we shouldn't forget Stelo either. That's their product aimed squarely at the non-insulin market.
How's that doing?
Pretty well, actually. It surpassed $100 million in revenue in its first 12 months on the market.
Wow, that's fast traction.
It is. And management sounds confident enough that they're planning to take it international relatively soon.
Okay, so this brings us back to the core puzzle of this whole deep dive. Execution is strong, these product catalysts seem imminent, the balance sheet is healthy. So why the massive 14.6% sell-off? Why is the market so fixated on this 2026 cloud?
It really comes down to how management framed the 2026 growth expectations. Now, they're very clear they were not giving official guidance for 26 yet.
Right, just commentary.
Just commentary. But they did state that their internal base case for the top end of the 2026 growth range is likely slightly below where Wall Street analysts currently have their estimates pegged.
Slightly below current street expectations. And crucially, what did that base case include? Or perhaps what didn't include?
Exactly. That base case explicitly includes only the coverage landscape that exists today, as in right now.
So it assumes zero success from future wins.
Correct. It doesn't factor in any potential benefit from major product launches like Smart Basal getting approved or further uptake of the G7 15-day sensor or, and this is the big one, any potential wins in securing coverage for the other half that commercial non-insulin type 2 population.
Okay, so that sounds incredibly conservative.
This is where you have to read between the lines a bit. Why anchor the base case only on today's coverage? In the medtech world, this often looks like classic sandbagging.
Setting the bar low so you can easily clear it later.
Precisely. Set an extremely conservative bar now, make sure you can beat it later in 2026, once the real impact of things like the 15-day system rollout and potential regulatory wins like Smart Basal actually start flowing through the numbers. It minimizes execution risk from their perspective and sets them up for potential sequential beats down the road.
But the bears, the skeptics, they'd argue that maybe this conservative frame is justified because of, competition heating up from Abbott's Libre and because of that margin reset we just talked about. Did management address concerns that maybe those G7 quality issues could pop up again?
They were pretty adamant on that point. They stated very clearly that the G7 quality issues, those out-of-box failures from earlier in the year, have been addressed, dealt with.
Okay.
They claim the quality of sensors coming off the manufacturing line now is, quote, exceptional. And their expectation to get back to record due patient starts in 2026. That's based purely on the coverage they already have and their confidence in their, let's say, newly improved execution model.
So it's a clear disconnect then. The market seems to be trading entirely off this very conservative 2026 base case scenario and the margin anxiety. While management is signaling, supreme confidence through things like cash debt settlement and share buybacks. Plus, they have this pipeline of catalysts. Some analysts, I saw William Blair, for example, basically called that huge drop a clear buying opportunity.
Yeah, seeing the guidance as just classic conservative bar setting before major product and regulatory news hit.
Exactly.
And that assessment, that idea of asymmetry, it's powerful. When you look at the strong Q3, the raised FY25 revenue guidance, and then this massive valuation reset driven purely by a conservative narrative, well, it suggests the market might have significantly mispriced the actual internal growth drivers.
Okay, let's call this the high conviction thesis segment then. If the market is maybe focusing on the wrong signals, what's the core investment thesis here? What's the trade?
All right, well, remember, this is absolutely not financial advice, just distilling the situation.
Of course, informational purposes only.
Right. But the thesis would be that the market is currently pricing in essentially zero regulatory success, like no approval for Smart Basal and close to zero material benefit from the 15-day G7 rollout picking up steam.
Total pessimism baked in.
Pretty much. And that creates the potential asymmetry. So a highly aggressive thesis might be initiating a long position in Dexcom shares, DXCM.
Buying the dip, essentially.
Buying the dip based on the belief that key catalysts, specifically, let's say, FDA approval of Smart Basal, and maybe that Q1 2026 data readout from their big type 2 randomized control trial, that these events will force the market to re-rate the stock well above current levels.
So betting on the pipeline, not the conservative guidance.
Exactly. The trade thesis is simple. We're betting that the internal innovation pipeline, not the conservative base case coverage assumptions they laid out, is what truly defines Dexcom's performance in 2026. Now, you could acknowledge there's some general medtech sector drag.
Yeah.
The whole space has kind of underperformed lately.
Right, so how do you isolate the Dexcom bet?
To hedge that broader sector weakness, you might couple the long DXCM position with a short position on a broad industry ETF, like IHI, for example.
So long Dexcom, short the sector, a pairs trade.
Precisely, making it a purely company-specific, catalyst-driven trade idea, betting on Dexcom's innovation against a backdrop of their conservative setup.
Okay. That definitely wraps up our analysis then of the Dexcom Q3 2025 earnings call. A really fascinating situation. Record-breaking quarter, immediately overshadowed by that margin update and management's deliberately conservative early peak at 2026.
Yeah, the core tension for you, the listener, to really watch now is between that solid near-term execution we saw in Q3 and this lingering investor anxiety over future coverage wins, especially in that big Type 2 NIT segment, and of course the ever-present competition from Abbott Libre.
So key things to watch going forward.
Definitely the uptake rate of the new 15-day G7 sensor. Is it gaining traction as expected? And critically, the timing and outcome of that Smart Basal FDA decision. That could be a major perception changer.
And just to reiterate, this deep dive is strictly for informational purposes. We're just distilling the information from the call and public commentary. It is absolutely not investment or financial advice.
Please, Always use this as just a starting point for your own research and due diligence.
Right.
But maybe here's a final thought to consider.
Yeah.
You have the company prioritizing paying down $1.2 billion in debt with cash and initiating aggressive share buybacks, specifically because of the current stock price level. Are they basically signaling that they see far more value in buying back their own future growth right now, effectively at a discount, than they do in potentially pursuing external M&A deals? What does that very clear signal of internal confidence suggest about the true, perhaps unstated, long-term value they place on their own pipeline?
Interesting question to leave things on. Thank you for joining us for this deep dive.